Bonds have been rallying over the last few days. What's that telling us, and where do yields go next? That's coming up on 3 Minutes on Markets and Money. Over the last couple of weeks, bonds have really started to turn the corner, picking up their non-correlation relative to equity prices. And that's exactly what you want to see for bonds to act as that hedge against a sell-off in stocks. Exactly what's been occurring. And taking a look at interest rates itself tells us a lot about maybe where interest rates are headed next, and what does that mean about the economy and the markets as well. Looking back to about the middle of April, we saw interest rates kind of pushing up, and this is where we were really starting to talk about potentially that peak of inflationary pressures. We weren't there just yet. Interest rates were pushing up around towards 3%. And that really started to form this left shoulder of interest rates here as interest rates kind of peaked. And we got that first inflationary print showing a slowing in the rate of growth by just a little bit. Interest rates did decline on that report, but then took off again as we began to see more inflationary pressures really still remaining consistent. We get the May report on CPI. And now that showed an actual decrease in the rate of inflationary growth, and interest rates declined here a bit. And then, of course, just from that initial sell-off, we saw a little bit of a bounce here in rates that peaked right at 3% again and forming that right shoulder. Now, what's important here is interest rates are now really starting to pick up some traction to the downside and are sitting on critical support here. That's that neckline of that head and shoulders pattern that interest rates are making right now. And now if interest rates continue to decline, we're going to see a break of about 2.7% on the 10-year Treasury rate. A solid break of that level of 2.7 is going to probably push interest rates back down towards 2%-ish on the overall 10-year Treasury. Now, why is this important? The reason this is important is that both interest rates as well as the stock market are starting to price in slower growth rather than higher inflationary pressures. So this is beginning to start to feed back into the markets. That's why we got pressure in stocks right now, slower earnings growth getting priced in. Inflationary pressures look to have peaked here. And if we start getting slower economic growth as the Fed is tightening monetary policy, which is what you would expect, we should start to see the completion of this head and shoulders pattern, lower rates. That's going to lift bond prices, which will again continue to hedge off that risk in stock portfolios. Now, with bonds acting as a hedge against risk in the markets, the other issue here and what could potentially push rates much lower here, of course, is the very large short position. As we talked about earlier this year, everybody hated bonds earlier this year. So a lot of these institutional managers, very light on bond exposure, underweight bonds in 60-40 allocations, short bond positions in general. Once we start getting that short covering and repositioning into bonds, particularly as we move into the end of June when we do portfolio rebalancing, there's a real likelihood that we could see lower rates and higher bond prices through the month of June. Just something to pay attention to in your portfolio. I'm your old Lance Roberts for 3 Minutes on Markets and Money. Be back here tomorrow.